All right, everyone. Marco Palmero, founder of Ulysses in Dubai, and welcome to another episode of Acquisition Case Studies, where we take deals that we have sourced, negotiated in the past, we break them down, we analyze them, and we find out what were the mistakes we made, the lessons we took away from these deals, and ultimately some key aspects that everybody can consider when entering a complex region like the Middle East. Again, the ultimate goal is to help all the business owners, executives, investors, and entrepreneurs that are looking to enter the United Arab Emirates or the Middle East, establish their own business there, maybe buy a company, because these deals will share a bit more about how the mentality works here in the region, how people think, how people interact, and ultimately how they sell and buy businesses. So in this particular case, I want to talk a little bit more about one aspect that it's quite common. I think it's a situation that happens quite often when you negotiate with small business owners. And I want to use this deal as an example because I think it's pretty evident what the problem was and what the issue in the thinking process of the seller was. So I'm going to give you the details again, nothing confidential, to make sure everything is protected from that perspective. But I will share with you the years of operation of the business that had basically been around for 15 years in the United Arab Emirates. So it was a fairly established company that had 3 locations across the UAE. So a pretty good business. And the staff involved in the business was around 70 people, out of which about 30 were the ones that were generating the revenue, the key producers, so to speak. Others were support staff. There was no real estate in the deal, so it was a pure and simple acquisition of businesses and the assets of the business. And the reason for the sale was retirement. Very common one in many parts of the world, but not so common in the United Arab Emirates. And I'm going to tell you the reasons in a second. If you watched some of the other videos that I recorded on the topic, you probably already know these answers. But the point is, the United Arab Emirates are a very young nation. They're only 50 years old. And 90% of the people here are expatriates, which means that fundamentally all the people living here are either first or second generation expatriates. Now, due to some of the complexities that are surrounding the country, because it's very difficult to get long-term visa, 10 plus years visa, people don't stay in the UAE for their entire lifetime. At least that's not been the trend, in the last years. It is a fact that 70% of the people in the UAE are between 25 and 55 years of age, which kind of shows you that people come in to work. They work until they are getting closer to retirement, and then they go back home. Now, the situation is changing because the government is issuing very good programs to incentivize people to stay after they retire. But the situation is changing, slowly, I would say. So why am I saying all this? Well, because it's very rare to find people that sell their business because of retirement. A lot of owners might want to exit the business to pursue other interests and maybe retire from UAE, quote unquote, but they will still do business in their home country. So the idea is that a lot of people get into UAE to make money, spend some time there, then they plan their exit to go back home. And it was kind of rare to find somebody who was actually selling because of retirement. It was quite unique. We haven't found a lot of deals that are exiting purely for retirement. And it was kind of cool, right? Because retirement is generally a pretty strong motivator based on my experience. And so the person is going to be highly incentivized in selling this business, not only because he might want to go back home, but also because he's coming to an age where he cannot be involved in the business. And this was exactly the case, right? The guy was overseeing these 3 locations by himself. He was getting tired. It was not easy for him to manage these things. And the kids were focused on completely different business lines. So they didn't want to have anything to do with the business, and he was basically stuck in a situation where he needed to sell this thing in order to retire, go back home, enjoy a bit of life. And that was an ideal scenario for us. It is something that we really liked. It was a perfect candidate, and we felt there was a deal to be made there, because generally speaking, retirement is a motivation that's going to keep the person aligned with the buyer for a long period of time. So we liked the idea, and we felt we could drive this deal to completion. But let's talk about the revenue, the last part of our initial overview. The business was making around $6.5 million a year in revenue. And in terms of profitability, it was making around 1.9 net. So pretty good business, right? Pretty good business, considering it is a brick and mortar business. 3 locations, so fairly established. It had been around for a long time. And the motivations were all the good ones. There was no real estate in the deal, which is something that we generally like. And it appeared like a business that could have a good future, provided we had the continuity and we were able to transition under our own operations these 3 locations. So we sat down with the owner and we started an interaction around this particular deal. Of course, we did all the initial soft due diligence, checked some initial documents and stuff like that. And then we started discussing pricing, and structuring around this deal. Now, of course, there are many variables that get involved when it comes to valuing the business. And of course, the valuation multiples greatly depend on the industry you're operating in. But for this particular case, the multiples that we were looking at were between 3 and 6 times EBITDA. And when it comes to EBITDA, we generally take the average of the last 3 years. We averaged everything out, and then we take a multiple of that number to kind of mitigate the risk and kind of have a little bit of a more equal number that we can use. But long story short, we said to the guy that we were looking at 3 to 6 times EBITDA for the business, subject to further due diligence and potential financing. The idea was to, of course, get the lower valuation possible out of the deal, but we were open to go up in value up to 5 and 6 times if the owner was open to consider earnouts, seller financing structure with heavy percentages of the deal being earnouts and seller financing, of course, because it would have reduced our exposure up front, our risk, and all these sorts of things. That's when the problem really started, right? The guy was an old man, very tough, and he came to the table asking for, if I remember correctly, it was between 12 and 15 times EBITDA, right? And I was like, that's bonkers, right? That's never going to happen. I mean, no small business deal is ever going to trade at that multiple. And I started wondering, why was it that he was asking for that amount of money? Because it didn't appear to be one of these guys that is just asking for the moon, hoping to get it, right? It appeared to be a reasonable guy. He had been in business for a long time. He understood his business very well, in also the financial aspect. So I was curious to find out more, and as we started digging and asked him some question about the reasons why he wanted that kind of valuation, he started giving us a series of examples of deals that had closed in the recent 24 months in the Middle East that were in his own industry, right? And he started saying, well, company X, company Y, and company Z closed at that multiple, so I'm going to expect the same multiple because I'm in the same industry, right? The only problem he took out of the equation is that those businesses were billion-dollar organizations, right? And they actually sold for billions. They weren't generating billions a year in revenue. But the point is, they were large companies. They were already very established, and that could exercise a different type of multiple for their business that wasn't really comparable to a small business generating, how much did I say? 6.5 million a year in revenue, right? The business was profitable, fine. It was very, very good. And we were interested in it. It was also cash flowing. So beautiful opportunity. But what the seller was lacking is a little bit of context and common sense around two different playing fields, right? Many times what we have seen, and what I've seen also in other markets, is that some sellers start to look at information online, especially the most savvy ones, and they start to look at how much could I expect to get for this business in this particular industry. The problem is they don't browse through these sites where they tell them clearly that small businesses only trade at certain multiples. They just read the top articles on each site that tell you how company in X sector exited for 20 times EBITDA. And that's the only thing they register, right? They look, wow, 20 times EBITDA, their head starts to spin. They look like a slot machine hitting jackpot, and they say, wow, I'm going to ask 20 times because, that's what the industry is trading at, and I'm going to make a ton of money out of this business. They fail to contextualize their deal and understand that big companies trade for a huge premium for a variety of reasons, one of which they build the infrastructure, they're much more stable, they have a portion of the market share which is sizable, which is very relevant, they are already in different nations, they have a whole sets of positives that small businesses don't have. The infrastructure of a big business can demand a premium, especially, of course, if the business is traded publicly. So the point is, the problem we were facing with this guy was that he was not being reasonable, and he was not understanding that the valuation of his business was going to be significantly lower. Now, why am I mentioning this case in this series? Because I think it's important to gain perspective on some of these deals, because this is a situation that happens very, very often. So when people have a little bit of experience around their sector, they're going to come out with these types of questions and or affirmations. And it is up to us as buyers to educate them on the fact that those are two different deals and you cannot value them in the same way. Now, some of you might say, well, I'm not even going to go through the process of explaining to them why the deal is not worth so much. I'm just going to pass on it and I'm going to focus on something else. That is a fair approach, but also I might add, you might miss some opportunities where the owner would be very reasonable if you were good enough to educate him on the process. I mean, I've seen deals where it really took us 30-45 minutes conversation to break this belief and kind of showed him that he was delusional about it. And then he started thinking more, in a ballpark, let's just put it this way. I think, from the Middle East perspective, a lot of people are going to ask for the moon just because they try to get the best bargain out of the deal. Those are just delusional people and you should disqualify them if possible. But the ones who bring out these types of arguments are generally quite reasonable guys because they already done their research. They know what they can expect for the deal. The only problem they had is that they interpreted the facts in a wrong way. And so my experience has been that with a lot of them, you can have a conversation and you can actually explain to them why that isn't the case for their business. Now, some of them will still tell you, well, I'm going to stick to my valuation, which is what this guy did, by the way. But I still think in some cases it is worth having that 30 minutes discussion, because you might end up in a situation where this guy says, okay, I'm fine. I'm going to accept your valuation, provided due diligence shows the same thing. I'm happy to consider the deal on these terms. That will be a deal in that case, right? And in most cases, what I found is that the guys who come back to earth and become more reasonable with the valuation structure generally are also a straight sale after that point, because they realize they kind of like they were pissing out and they were not thinking straight, and so they try to stay within lanes after that moment, and generally the deal progresses much better. Some of them just waste your time, right? And they're gonna stick to that, and maybe they will play around with no intention of going down on the valuation. So I guess it's just a trade-off of understanding really the person you're in front of. In this particular case, I thought we could have had a good discussion. In fact, we tried to show the person why this deal could not be valued at that amount. Unfortunately, that didn't work, which, some of you might say you wasted 30 minutes of your life. It is fair, but it is also true that we could close a good deal there. So I wanted to invest that 30 minutes to educate that person and then see if we could get a deal across. That didn't happen, but it's fine. I think overall, when looking at small deals here in the region, I want to be a little bit more open to conversations, especially because a lot of people are going to try to bargain with you, and if you pass on every single person just because something is not checking out 100%, chances are you're going to struggle in finding a deal, just because of the way people approach things here. I had an engagement with a company that was very strict in how they approached negotiations. It was either their way or the highway. And I appreciated that approach, but the problem was they weren't able to get any deal across the goal line, or they weren't even able to get to the due diligence phase because nobody would accept that approach. Everybody wanted at least a little bit of negotiation, just because of the nature of of negotiations here and how people deal in the business arena in the Middle East. So I'm talking a lot here, but the point is, I think first point and first lesson we took away is that, of course, a lot of sellers are going to be delusional, and it is our obligation, our job to educate them on what reality is all about. And then the other aspect is clearly telling which person is worth investing the time. It's also important. And being a little bit more flexible in how you interact with people can also be a service, because you're gonna have much higher chances of getting a deal across the goal line, getting a deal through due diligence, and having a person that is ultimately committed in doing a deal. Because a lot of times I've seen that these guys that try to play it tough early on, then they're pushovers after you overcome that barrier. So that's one of the reasons why I sometimes invest that 30 minutes in the education process, because if I know if one of them cracks, then it's a much easier sale, as I said before. So those are some of the considerations on this deal. Hopefully you find this video helpful, and I'll see you in the next episode.